Good morning, everybody. Thanks for being here with us this morning. I'm Cyril Regnat, head of the research solutions, and this morning we're going to talk about green bonds, green and sustainable bonds for our quarterly review. With me this morning, I will have Ivan Pavlovic, our energy transition specialist. Hello, Ivan.
Hello,
who's gonna speak about the global trend in the green and sustainable bond market, and as well we'll be covering a very interesting subject, with a focus on RePowerEU and its funding needs. Then I will be speaking about the trend, not on a global basis, but specific trend in the EU and govies green bond market, with once again a focus on Europe. And last but not least, Samy Lakhdari, our financial institution analyst, will be speaking about financials covered and banking, of course, institutions. And well, it's going to be very interesting, of course. And we are gonna leave the floor, of course, to Ivan. Just a small reminder ahead of his speech. You can, of course, ask your question using the Q&A button you will find on your Teams app. Thank you very much, and a very good conference to you. Ivan?
Yes, thank you, Cyril, and good morning, all. Can we go to slide number 3, please, Kenza?
I think we are seeing the slide number 3, Ivan.
Pardon me?
We are seeing it.
Okay, because I don't. Okay, no worries. Okay, so I'm going to briefly mention the overall green and sustainable issuance volumes. And then, as Cyril mentioned, I will be focusing on RePowerEU. The European Commission's aim to diversify gas supplies away from Russia and to accelerate the energy transition. And I will briefly comment the implications such political moves could have on the green bonds overall issuance volume. So let's start with the key figures for green and sustainable issuance volumes in Q2. So basically what we saw in Q2 is the continuation of what we saw in Q1, namely a year-on-year decline in issuances, with overall volumes standing below 200 billion euros and euros equivalent, so over the past quarter. So clearly what we saw is the overall issuance volumes affected by a clearly less favorable issuance volumes for corporates. So corporates that had been, you know, key players in the green and sustainable bond market, you know, were affected by a less favorable macro and markets environment in the context of the war in Ukraine. Nonetheless, and that's a key element to mention, the overall outstanding volumes of green and sustainable bonds remain on the rise, reaching 2 trillion euros and euros equivalent at the end of June 2022. So that's it for, I would say, the general, market picture. I will now move to the focus on RePowerEU. So Kenza, if you can move to the next slide, please. So RePowerEU is a very, very interesting topic for in the perspective of the green bond market, because it's a very bold policy move from the European Commission to diversify EU's gas supplies away from Russia. So you may be aware of the fact that overall the EU relies on gas imports from Russia in the region of 45%, representing over 130 billion cubic meters of gas. So the idea underlying RePowerEU that was announced by the European Commission on May the 18th is to cut this dependency as early as 2027. So the interesting thing about RePowerEU is that to some extent in the early years, it is a plan focused on energy supply and security of supply, given the potential disruption in gas supplies in the coming months for Europe. But it also, more generally, an accelerator of the various energy transition initiatives underway at the EU level. You may be aware of the fact that the European Commission announced a very ambitious climate policy package in July 2021. This is the Fit for 55 package. This package aims to align EU's climate policies and regulation with a new intermediary greenhouse gas emissions reductions target of minus 55% by 2030 from 1990 levels. So basically, what EC's RePowerEU plan does is to a large extent expand the perspective already set in the 50-55 package. So looking at RePowerEU, as I mentioned, it's a complex plan. It's a sort of three-legged approach to ending dependency on Russian gas supplies. Basically, there is a short-term focus, and then there is a medium-term and long-term, I would say, approach to ending this dependency. So clearly, in the short term, the focus, as I mentioned earlier, is on energy security. So the idea is clearly to diversify EU's energy supplies away from Russian gas. So how is the EU going to achieve this? Well, mainly in making use of existing gas import infrastructure to the best possible extent, but also in expanding gas import infrastructure in order to diversify gas supplies. And clearly, the big partners when it comes to gas supplies are likely to be Middle East players like Qatar, as well as the United States. So that's, I would say, one of the key elements. Another element to mention, which is not a big news or a big signal from the perspective of the energy transition, is in the power markets to accept additional or incremental production from coal-fired plants, particularly in Germany, to substitute for gas that may be missing for power generation purposes, or that may be too expensive in the power markets. Now, looking at the medium-term to long-term perspectives, the focus is very different. The idea basically is to amplify all the measures that have been part of this 50-55 package I mentioned earlier in the field of renewable electricity production, energy savings, and development of new energy vectors or primary sources across the EU. And obviously what we're talking about is the potential or the accelerated development of biomethane, but also, and more importantly, of hydrogen, renewable hydrogen. And just to give you an idea of the amplitude of RePowerEU's move, is that by 2030, the target in terms of renewable hydrogen supply for the EU will move from 5.6 million tons per annum under the Fit for 55 package to an amount of 20 million tons per annum, of which 50% will be imported. And underlying RePowerEU, what you have is a comprehensive plan to set an EU-wide import policy with third countries to accelerate the supply of renewable hydrogen across Europe. So that's, I would say, the big picture for RePowerEU. So as you can see, it's a very ambitious move. Not only does it target, I would say, a clear extension of gas supplies as early as 27, as I mentioned, but it also underlies or underpins a very ambitious, energy transition plan. And the idea is clearly to accelerate the move away from fossil fuels, so not only gas, but also in the long term, oil and coal within the EU. So now moving to slide 4, I think it's quite interesting to look at the potential implications of this plan on the supply of green and sustainable bonds within the EU. So to give you broad figures, as you understand, RePowerEU marks a clear step up in EU's energy transition policy, and investment-wise, what the European Commission expects is the total amounts of investments, associated with RePowerEU is to represent an additional, I would say, investment volume of 210 billion euros through 2027 from, I would say, the investments underlying Fit for 55. And this incremental investment volumes would amount to 300 billion euros through 2030, obviously compared with the investments underlying Fit for 55. So obviously the big question is to what extent the green and sustainable bond market can absorb this substantial incremental investments and accordingly issuance volumes. So to answer the question, we have taken we have made the assumption that European utilities, which are already very substantial players in the green and sustainable bond market, will be undertaking this incremental investment effort, and this will translate into additional issuances in the green and sustainable bond market. So obviously what we would expect is this incremental investment effort underlying RePowerEU to translate into incremental capex from European utilities in the region of 25 billion euros per annum. And from a green and sustainable issuance perspective, this would translate into overall annual volumes from utilities standing in the region of 40 to 45 billion euros through 2030, which compares with levels of 35 billion euros seen annually over the past few years. So obviously you have a big supply issue associated with this incremental capex effort, and clearly as the graph on the left side of the slide shows, the incremental EBITDA associated with this incremental capex effort will not follow, which means that from a EBITDA to net debt perspective, leverage ratios displayed by European utilities are likely to slightly deteriorate, in the next years. But I would say the good news, and that's very important from a, I would say not only credit perspective, but from a bond supply perspective, is that the assets that will be developed by European utilities, we talked about renewable generation capacity. We're talking about power grids expanded, reinforced. We also talked about potentially electrolysis capacity deployed all across the EU. So we're talking about assets that are of regulated or contracted nature. So obviously offering very stable streams of cash flows once the assets have been commissioned. So clearly from a credit profile perspective, we expect this incremental capex effort not to weigh substantially on European utilities credit profile, simply because the underlying assets are very good credit quality. And another element to mention, which is quite obvious, but as you can see, renewable power generation assets, power grids and electrolyzers that will be powered by renewable sources are all, eligible to green bonds. They are all, recognized as green assets by the EU taxonomy, which means that they will be financed by green bonds mostly. And obviously, we expect this market to be of considerable help to utilities to find the appropriate financial resources. So now I'm done with my part, and I leave the floor to Cyril for focus on sovereign issues. Thank you very much.
Thank you, Ivan. Thank you very much. And speaking about sovereigns and VU, if we can go to the next slide, the activity has been picking up quite markedly during Q2 of this year, and it's a bit in contradiction with the global decrease Ivan talked about just a few minutes ago. So activity has been picking up with roughly 29 billion euros of supply during Q2, notably with a very strong supply by VU. It was expected IVU during Q1 of this year was probably lagging a bit behind his schedule in terms of green bond issuance. So VU has been catching up quite nicely during this second quarter. Interesting to say as well is the fact that we had a couple of new bonds, new issuances, notably, of course, the first ever inflation green bonds by the French Treasury. So first linker ever. So new format for the market, with once again quite a great success for the French Treasury, and two other sizable issues by the Austrian Treasury, and of course the Dutch Treasury, the DSTA, with 4 and 5 billion raised by the two treasuries on these two operations. So in terms of market dynamics, we can clearly see on the left-hand side chart that the EU is closing the gap with notably the French Treasury, which as of today is the sovereign issuers in Europe with the biggest outstanding amount of green bonds, roughly 60 billion euros, while the EU is now standing around 30 billion euros. If we go to the next slide, so what has been happening in terms of greenium and in terms of, let's say, bid-offer spreads on this sovereign plus EU green bond market. Interestingly, greenium have been rather stable, notably if we look at the German ones. The greenium for the Bund August 30 or 31 have been hovering around 2 BPs over the past few weeks, despite a very challenging market context once again. On the French side, we know that French OATs, French green OATs have been outperforming a bit classical nominal OATs in terms of asset swaps. So interesting, once again, given the very volatile market context we've witnessed. On the bid offer side, though, of course, we kept having very large spreads. So the right-hand side slide chart, sorry, once again illustrates the current trend on some kind of worsening, notably during the second half of June, during which we've seen a very strong widening of all bid offers, nominal bonds, classical nominal bonds included, notably. So all in all, not very significant changes when it comes to greenium or bid offer. Just that market-wise, of course, given their lower liquidity and lower turnover, notably, so these bonds have been let's say struggling a bit more in terms of bid offer, but what is very interesting is that the greeniums are now stabilizing, which is of course a very good news for the green bond market. If we can go to the next slide, our expectation for the third quarter of this year. So of course, the level of supply should decrease somewhat, notably in August, but in July we're going to have, of course, some taps starting today, of course, with the French IFT and its tap of UAT 44. Activity notably is expected to pick up a bit more in September, during which we expect, in fact, some treasuries to issue new bonds via probably syndication. We can think notably of Belgium, of course, which have been for now many months expected to issue a 15-year to 25 years. So September could be a good timing for the Belgian Treasury to issue a new green bond. Italy has been announcing I think today that it's intent to issue a new green bond, and Italy in this regard has been lagging behind peers since the beginning of the year, because so far we don't have any tap or new bonds, new green bonds issued this year. So clearly there was this need, and today's communication is timely because we do expect Italy to raise up to 10 billion euros this year via green bonds. So it's likely it's going to be perhaps in September or in Q4 of this year. The EU will stay as the leading bond issuer, green bond issuer during the second half of this year, due notably to its 50 billion euro funding needs for the second half of 2022. So the EU will have to raise up to 17 billion euros of green bonds during the second half of this year. So roughly 8 billion euros per quarter, which means that the EU will at least issue a new green bond per quarter. So maybe in September for its next new green tranche, and either in November or December for the latest one. The EU has been announcing, I think, either today or yesterday, but anyway, it's intent to issue 5 new tranches via syndication during the second half of this year. So 2 of those 5 should be green bond issues. In terms of global supply for the second half of this year, we are a bit behind, let's say, the target. Our target for the whole year, including the EU, is of 90 billion euros. And by the end of the first semester of this year, we were standing roughly around 38 billion euros. So about 52, a bit more than 50 billion euros of green bonds to be issued during the second half, which is quite a nice amount for investors, with once again the EU being the biggest issuer in this regard. So during the past quarter, and notably during Q2 of this year, the EU represented roughly 50% of all green bond issuance on the euro, let's say, govie space. For Q3 of this year is going to be more or less between 35 to 40%. For Q4, it's likely to be probably above 50%, because most govie issuers will probably have mostly completed, in fact, their green bonds issuance program for the year by the end of September, probably. If we go if we can go to the next slide, one important topic for the second half of this year, and a long-term topic for all of us on the green bond side, and here we are not focusing on govies, but more on corporate bonds, is that the ECB has been announcing 3 days ago its new green bond framework, notably for corporate bonds. And in here you have the first, let's say, the 3 big guidelines regarding, in fact, this new bond framework, which for which the let's say decision making will be progressive, but as you can see, we are clearly seeing, let's say, 3 different categories when it comes to this new framework. First one being, of course, the reallocation, in fact, of corporate bonds proceeds on the CSPP portfolios of the Eurosystem. So what does it mean technically is that the Eurosystem, starting in October of this year, will start reinvesting the proceeds of its maturing bonds a bit more on low carbon footprint, in fact, corporate bonds. So clearly, it's going to have at some point, of course, an impact on corporate bonds market valuation, and an impact as well probably on the behavior of investors. So it's going to be the first step. So reallocation of reinvestment towards low carbon footprint corporate bonds, first step. Second step will be on the collateral framework, which is, of course, very important, because collateral framework is a way for banks to, let's say, participate into TLTROs, into long-term refinancing operation. All of these operations provided by the ECB. So regarding, in fact, the collateral framework, the ECB has been communicating that it's intended, in fact, to modify notably its haircuts on collateral, which means that basically the haircuts on high carbon footprint corporate names will be higher than the haircuts on low corporate carbon footprint names. So once again, we are seeing a clear disconnection between high and low carbon footprint corporate names. It's going to be a progressive, of course, evolution, because regarding this collateral framework, the first step and the easiest step, of course, will be to modify this haircut grid. Then, of course, we're going to have, let's say, some kind of strengthening of this collateral framework by notably excluding, at some point, the high carbon footprint names, which in this case will have probably a deeper impact in terms of valuation, because as long as you're excluded, you are not eligible in all the market operation done by the ECB. So in this regard, it's going to probably to have a deeper impact in terms of market valuation. This later step regarding the collateral framework is expected to be applied as of 2026, so in 3 to 4 years. But still, the market and investors are likely, in fact, to front run somewhat, in fact, this particular evolution. So first step, and it's quite logical, and it's really anyway in line with the first 2 steps, which are going to have some market impact in terms of valuation, and of course, big impact in terms of collateral eligibility. It's the rating, in fact, of the ECB and rating of independent agencies such as S&P, etc. The ECB will be urging, of course, independent rating agencies to include in their ratings process, so climate risk, which means that at some point we're going to have probably some downgrades on high carbon footprint names. The ECB itself will, of course, include the same risk inside its own in-house credit assessment system, with the idea, of course, of penalizing probably a bit more these high carbon footprint names. All in all, so it was expected, but the ECB has been delivering this roadmap 3 days ago, and is going to have quite a deep impact probably in terms of valuation for credit for corporate bonds at some point. And I'm pretty sure we are pretty confident on the fact that investors will be willing to front run these decisions made announced by VCB 3 days ago. VCB will publish some details in probably ahead of October 22 on how it's intend, of course, to shift its portfolio, but it will definitely have some impact even ahead of October 22. We believe so. I'm done on my part, and now I think Samy will be talking about financials, starting maybe we've covered.
Thank you, Cyril. Good morning. Yes, the next slide, please. Yes, thank you. So issuers were particularly active on this segment, and in particular with the ESG cover bond format, because the total issuance reached a record this quarter with a total volume of 7 billion euros. It represents an increase of 56% year-over-year and 80% quarter-over-quarter, and the share in the cover bond market increased from 5% to 70% this quarter. Investors are still attracted by ESG cover bond, and the oversubscription rate increased strongly from 1.7 to 2.8 times, while the demand for conventional cover bonds stabilized to 1.5. Also, in terms of performance, we observe that the post issuance, or 30 days after the issuance, conventional bonds and ESG cover bonds perform in the same way. Less than 1 basis point on average. And just to give you some colors about largest issuers, largest ESG issuers in terms of volumes, they are based in France because they explain 30% of issuances, followed by Germany and Norway. On the next slide, on the senior preferred market, so the trend is different than we observed for cover bond, because on the senior pref, and in particular for green senior pref, they reached a record in terms of issuance volume in the first quarter 22, but now they only issued 2.25 billion euros this quarter. But investors are still attracted because we observe that the subscription rate was higher for ESG senior pref bond rather than senior pref conventional bonds, around 1.70 times for ESG senior pref bond. But in terms of spread compression versus the IPT, it was slightly lower for ESG senior pref bond. But there is a point that it is very important to point it out, is the level of NIP, because we reached the highest level since 2018, near to 18 basis points. And to give you an example with BAB Bank, they issued a 3.5 during the second quarter 22 with a NIP of 14 basis points. And they also issued in the first quarter 22 a 5-year bond with only 1 basis point of new issue premium. So definitely, in order to attract investors, issuers have to display higher NIP. And on the next slide, on the senior non-pref, the trend is very similar if we compare it with the senior pref, because they issue much lower ESG senior non-pref compared to the first quarter. The level of issuances stood at 3.75 billion, and banks based in the Netherlands was particularly active this quarter. We had the Volksbank, which issued senior non-pref, and also ABN AMRO, which tapped the market with a dual tranche this quarter. But investors are still attracted, and the bid to cover ratio was above 2.15 times for ESG senior non-pref, and it was above also conventional senior non-pref bond. And in terms of yes, bid to cover, just to also give you an example with Dutch Bank, because Dutch Bank came on the market with a 6 year, and the over subscription rate was around 6 times because they came with a 500 million euro bond, and the book, the ordered book, was above 3 billion euros. And in terms of NIP are still high, around 18 basis points this quarter. And in terms of performance, spread compression versus the IPT, the trend is similar compared to previous quarter. And senior non-pref, green senior non-pref bond achieved a lower average spread compression than their conventional peers. That's it on my side. Thank you.
Thank you very much, Samy. So keep asking some questions. We are receiving some of them via, of course, the Q&A app of Teams. Just received one question regarding, in fact, ECB announcement, of course, and of course how it will impact, in fact, issuance. It's clear that issuers belonging to the bond sector in this context will probably have to favor SLBs or green bond formats in order to not being too penalized when issuing some bonds. So definitely, I think this is what we saw anyway during the last 2 to 3 weeks, that in a very difficult market context, all corporates have been issuing a bit more SLBs or green format, because we know that the final demand, final investors demand is still there, is still strong, even though the size of order books have been falling a bit as of late, including the EU. But still, it's very interesting to see this momentum going on. We know that all ECB's decision making will somewhat reinforce the trend we've been seeing since the beginning of the year, in terms of course, green bond issuance, of course, and both on the sovereign and on the corporate side, but for sure on the corporate side, the ECB's announcement will have an impact. And so far, the ECB has been focusing on corporate, but at some point, it's very likely the ECB will be looking at financials as well, notably, of course, covered bonds. Potentially, it could be, in fact, a first step of its, let's say, of this new collateral framework guidelines, so including at some point covered bonds, and it's likely to have, of course, an impact as well. Do we have maybe another question? Nope. Samy or Ivan, do you want to add something or share something additional about your feeling about what will happen during the second half of this year? Ever regarding RePowerEU, we know that we had the resubmission of the let's say multi-year plan for European states, because with this RePowerEU, it's a game changer. The initial allocation inside Next Generation EU was done last year, but the situation obviously evolved quite drastically. Ivan, you want to share Anything additional?
Thanks, Cyril. You're raising a very interesting question because one of the challenges surrounding the adoption of RePowerEU is that it goes beyond this framework I mentioned, which is Fit for 55, whereas Fit for 55 is still under discussion between the European Parliament and the European Council. And a series of provisions under the Fit for 55 package are still somehow controversial. You may be aware that the European Parliament adopted, I would say, an amended version of the reinforcement / extension of the EU ETS, or the carbon markets. But some of the provisions of this plan are still controversial within the European Council. We're talking mostly of the phase out from free allocations for industrial activities and the entry into force of a carbon border adjustment mechanism, which will mimic with EU's trade partners the phase out of free allocations for industrial activities at risk of being relocated in the event of a substantial toughening of the carbon constraint. This is cement, steel, chemicals production in Europe. And why I'm saying this is because obviously, when we talk about energy transition and a clear step up in the ambitions, what remains to be seen is whether we see this alignment of all stakeholders, even at the European institutional level, to make all these pillars of the RePowerEU enter into force as early as possible. So obviously, what we talk about this morning is a very ambitious plan. As I said, complementing, expanding what is already, being discussed at at Fit for 55 under Fit for 55. But what remains to be seen is whether the European Commission will get, I would say, the broadest political support to enact the various pillars of this plan and translate them into, positive EU law as early as possible. Which is the reason why all the events we're talking about for the time being somehow theoretical.
I see that we just received another question from Tessa. Thank you. How will the inclusion of gas and nuclear in the taxonomy affect issuance? Maybe I don't know. That's even
Yeah, I can bring some comments on the inclusion of gas and nuclear. Well, yes, obviously this could have some impact. But the thing is, we believe that the bulk of the investments, and if we make the link between, I would say, the taxonomy and RePowerEU, I think the bulk of the assets to be financed and to be deployed. First, to be deployed under RePowerEU and then to be financed eventually by the green and sustainable markets are fully taxonomy eligible. We're talking about renewable generation capacity, grid strengthening and expansion, talking about renewable powered electrolysis capacity. And so for this reason, the European Commission made it very clear that only 10% of the assets to be deployed as part of RePowerEU will be fossil fuel centric. The rest is clearly, fully aligned with the EU taxonomy. So for this reason, I think that the main point is that gas and nuclear assets, are still under discussion, and there's uncertainty as regards whether they will be, eventually included in the taxonomy, but that's really not, I would say, the main part of the game. The main part of the game lies in all these assets that will eventually, that are clearly earmarked in RePowerEU, and that will contribute to EU's moving away from fossil fuels. That's for gas. And for nuclear, if you look at RePowerEU, I think that from a political standpoint, we see only now a few countries willing to make extensive use of nuclear for the energy transition. So I don't think it's really the major element, at stake when it comes to green and sustainable issuance volumes.
Thank you, Ivan. Another question on RePowerEU, definitely a very interesting subject. Notably the low return, in fact, of some of the technologies you've been mentioning, probably clean hydrogen, etc. We know that corporates and the private sector will be less willing to participate in case this kind of projects are offering low returns. According to you, what would be, in fact, this participation of the private sector? Or would the EU be able to finance everything itself?
No, it's a good question that has been raised. Well, quite frankly, you know, I'm taking part in a series of governmental discussions, you know, across Europe on the appropriate return for, you know, low carbon technologies. That may include renewable hydrogen, can include, you know, other technologies that are probably more in the maturation phase, like carbon capture. And I think that the general principle linking returns and risk profile, you know, remains, you know, centric. I think in all the discussions we can have, you know, in onboarding the private financial sector in the financing of these emerging sectors. So to be very frank, when we're talking about renewable electrolysis, from, I would say, a technology perspective, electrolysis, you know, has been in place for nearly 1 century now at industrial level. The problem we are facing in Europe is moving or bringing at scale the existing, you know, manufacturing capacity and deploying assets to produce hydrogen in Europe. So the issue is not, you know, about, you know, mastering the technology, which is well known, but rather to bring it at scale. And that's the reason why in RePowerEU and Fit for 55, you have a series of regulatory provisions to support sustainable demand build up in Europe for hydrogen. I think that's really the main point. So from a return perspective, as long as the technology is well in place, you know, with a TRL, the technology readiness level of 9 and 9+, we are with something that is already enjoying commercial deployment, and so there's no major risk. The risk will be from an industrial standpoint in scaling up manufacturing capacity and deploying, you know, bigger and bigger electrolyzers. Just to give you an example, for the time being, to the best of my knowledge, the biggest electrolyzer currently up and running is a 20 megawatt electrolyzer. It's in Bécancour, Canada. If you think, for instance, of Antwerp, Plug Power announced an electrolysis project of 1 gigawatt. So as you can see, there is a major step up in terms of electrolysis capacity. So what is at stake for investors? As I said, you know, it's all about, you know, bringing at scale the technology, and what you need to enable this move is to deploy contractual frameworks supporting, you know, the development of assets and the sale of hydrogen under contracted, you know, contracted regime, allowing the producers of electrolyzers to earn stable and predictable revenues over the asset's lifespan. Once you have that, you have something that is very similar to what we have in place for renewable energy production across Europe, the feed-in premium system. And because of this, what we would expect eventually is that the rate of return of electrolyzers will converge at some point with the level of renewable electricity assets across Europe. So for this reason, yes, returns won't be that high, not necessarily now, but in a couple of years from now. But this will be, I would say, a fair reflection of the underlying risk for project developers, as well as, you know, capital providers, banks, and investors.
Thank you. Maybe a last question once again for you. So it's live. We know that France is willing to nationalize EDF. So do you think we're in for some kind of wave of renationalization of European utilities firms?
Very good question. I think that France's case is probably a part, given that EDF remains, I would say, the cornerstone of France's electricity sector, as well as energy transition policy. And as you know, EDF faces a series of technical, operational, and now financial issues, alongside obviously a regulatory environment that is not, commensurate with, I would say, the market environment for power production across Europe. So we have a series of challenges that are very, very specific to France and EDF. And now, the nuclear industry being very capital intensive, in particular for the next, the current generation being deployed. We're talking about the EPR, the generation 3 EPR, in Flamanville, but also in the UK. There are very, very specific, risks associated with nuclear. For this reason, I see the nuclear industry, standing, apart. And obviously, as I mentioned earlier, if you look at RePowerEU, the nuclear industry is not the #1 option to diversify, energy supplies away from Russia, particularly when it comes to gas, and clearly not, the #1 option to accelerate the energy transition. So for this reason, we see EDF, standing apart, and we don't expect, a massive wave of nationalizations of European utilities, keeping in mind that most of them are 100%, privately held. And that their business plan, revolves around grid development and new renewable capacity additions, something that is very well, financeable by capital providers, be it banks or investors.
Thank you, awesome. Thank you very much for your answers. And for all of these questions, I think we'll be able to close this quarterly bond market review conference call. Thanks to Samy, thanks to Ivan once again, thanks to the communication team for organizing this conference. Thanks to our listeners and readers, of course, once again. And I say to you, well, have a nice summer, nice holidays, a nice break, and we see all of you here, all of you maybe in September for our next rendezvous. Thank you very much.
Thank you all.